We're going to be looking at the trend lines. A trend line is a straight line that connects two or more price points and then extends into the future to act as a reference or a line of support or resistance. Many of the principles applicable to support and resistance levels can be applied to trend lines as well. One of the first things people ask whenever they start analyzing charts and dealing with trend lines is, where do I draw them at? What points do I use? And to answer that, you could literally use any point you'd like. There are a few caveats though. First thing you need to know about trend lines is that they slope up or slope down. Here we have an up-sloping trend line. Here we have a down-sloping trend line. Okay. These trend lines, I could draw them all day long and just mess this chart up galore. It doesn't really help you if you get too much going on in there. It just becomes difficult to analyze. But the main thing is that a trend line will have a positive slope, meaning that it points up or slopes up, trends up, or it have a negative slope, meaning that it points down, trends down. A negative slope is a bearish trend line. A positive slope is a bullish trend line. Let's clean that up. Alright, a trend line that has a positive slope or a bullish trend is going to be based on at least two low points, preferably the more the merrier. It's going to have at least two, and they will be located on the lowest points of your price chart, wherever you're in. It can work on intraday, long-term charts, it doesn't matter. Whenever you're looking at it, you're looking at the buy pressure. The point that buy pressure was the strongest would be obviously where price stops selling off. So that would be the first point. You could use one here, one even here if you wanted to change up the way you drew this. And then you will see that the breakdown occurred here. Oftentimes, whenever your support line is broken and you have a close below that support like you did here, it will begin to act as resistance. What was once support turns into resistance when it's broken. So then you see it resistance here, 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 and here. Let's clean that up. Looking at trend lines that are negative or bearish trend lines, you look at the high points here, you can draw a line there. Right? You'll notice when you draw that line out, you get that resistance point, and you start to see a breakout above that where price closes above that. All of a sudden, this resistance line begins to act as support. You start to find support here, here, and here. The more times a trend line is tested or touched or tagged over time, the stronger it becomes, the more you can trust it. Also, if it extends over a longer period of time, for example, if we were looking at a chart that had been touched on a downtrend or an uptrend 3 times over 3 weeks, it would not be as strong as a trend line that had been touched 3 times over 3 years. One word of caution regarding drawing trend lines is be sure not to draw them with the first 2 points that you're drawing along too close together. There should be a good amount of space and time between the high points that you're using in a downtrend or the low points using in an uptrend. Okay. In this case here, that would be proper. You had a nice move here, pull back, reactionary high, pull back really deep here, come through, and you broke out right there, close above it. Some analysts will look for a breakout as being a close above just for one particular candlestick. Others will wait for a percent move, maybe 3%. Others will wait for a period of time to break out. For example, instead of being one candlestick broken out and closed above, they will wait for 3. That's a different method you might use, depending on the trading style you're using. However, if we tried to draw a trend line based on points that are too close together, for example, here and here, the trend line would not have any effect. It's not actually real. It's just an illusion, so to speak. It's not going to have the strength. Okay, so you want a trend line that's based on highs or lows over the chart that you're looking at. In some cases, you will find what looks like a trend within a trend. Basically, you could draw out this trend line here and here and have a larger trend. And someone else could also draw between here and here and have a shorter trend within an overall uptrend. Another way to draw that would be from a downtrends perspective. You got the tools. This high point, you get a downtrend line. Those points may be a bit too close for some analysts. They would prefer more distance between these 2 points. Another way would be to draw an internal one here to here, using this high point and this high point. Using internal trend lines will help you track whenever you've got a situation where volatility has increased or momentum has increased, whether upside or downside. Kind of gets you out, or allows you to get stopped out before the larger trend breaks down. May give you a little trade in there, so that's something that analysts will use a lot of times. One item to note regarding an uptrend or a downtrend. In a situation where you have a piercing of that trend, whether in this particular case you had a low point here, base that trend line off of, and then a couple days later we saw price activity dip below that trend line and pull back up above it. A lot of analysts will look at that and say it's not a broken trend line because it didn't close below it. That's, you may use that method. There's nothing wrong with that. However, I like to point out that I've noticed over the years of doing this that whenever you have a situation where price activity does dip below that and pull back up, I call that piercing the trend line. Typically, it's a warning that the trend line is about to break down, and it wasn't very long later, and you saw that trend line did in fact break down. Trend lines are a very valuable tool for any technical analyst, anybody who's trading stock out there with a technical bias. You're going to want to understand trend lines. They are one of the strongest indicators that you'll have out there. You'll hear guys talk all the time about don't fight the trend. Well, if the trend is moving up, you don't want to be trying to sell it or short it, because you're going to lose more than you win in that case. You won't have the strength behind you. Notice here in an uptrend, if you tried to sell, the weakness of the selling was 1 day here, 1 day here, 1 here, 1 here, 1 here, while the buy days were 3 here, 3 here, 3 here, and 3 here. Same goes for when you're in a downtrend. If you're in a downtrend and you're trying to buy, you've got 1 up day here, 1 up day here, you've got 4 down days